Folks, thanks for coming on today. Okay, yeah, Jeff Clark here, GoldenCare USA. Thank you guys for coming on board today. We'll be doing a webinar by the name of Designing LTC Plans for Affordability. If you've been along, first of all, my name is Jeff Clark. I'm with GoldenCare USA. I've been with GoldenCare for 25 years, and I've written, I don't know, about 700, 800 long-term care policies, I guess, in my career. My job now, the last 15, 20 years, has been to kind of help recruit and train and help agents with, designing plans, selling plans, whether it be associations, groups, individuals, putting proposals together for them, just kind of coaching them, helping them write more. So one of the things that we do run into trouble with now is the long-term care market's gotten expensive. It's just got to the point where we used to be able to just sell unlimited benefits, $6,000 a month, 5% inflation. Well, over time, long-term care has gotten more and more expensive. Not because the long-term care companies are trying to make more profit, it's because they're really kind of taking the shorts. Claims have been way more than expected. Long-term interest rates in this country have been in the tank. So that's why you only have 3 or 4 companies left selling long-term care when 10 years ago you had 100. What I do tell my clients in that situation is, look, if 97 companies have left the market, that means it's not so good for them. Insurance companies don't leave markets they're making a lot of money in. They leave markets they're not making money in. So I tell that story because really, even though these companies have left and it's gotten more expensive, it just tells me that it's still a very good deal for the consumer, not so much for the insurance company. So this is part of why you've seen the rates, we're not talking rate increases on existing blocks. The price for buying new long-term care has doubled and almost tripled in my 20 years of doing this. So we really have to be careful about how we design plans now to still give that customer the most bang for buck possible. Still trying to keep premiums low, but giving them some meaningful benefits that can actually help them. And that was kind of the premise of this. Part of why this came up is because Mutual Omaha, like the other 2 carriers, Thrivent and NGL, adjusted their rates recently. I say recently, actually, it was about a year and a half ago now. But with this, they did some things with cutting some of the policy benefits, getting rid of some of the discounts for husband and wife. They changed the 3% compound inflation rider cost, and so as a result, you saw rates go up on new policies now anywhere from 10% to as much as 40% in some areas. So we want to kind of come out with a webinar that would kind of show you how to kind of ward off some of that extra cost, and so we don't basically break the bank here. And so that was kind of the modus operandi here of this webinar. So premium rates, and this was Mutual hadn't changed their rates since the fall of 2013. So really in 2020, I think it was September of 2020, a couple of years back, they finally kind of refreshed their rates, redid something, tweaked some things. So, but it's not just Mutual. It's not, just National Guardian Life. Companies have had to do this over time just to make things work as far as long-term interest rates and claims data. And they've got a lot of actuarial claim data coming back. You kind of know where they should be priced to begin with. And so even though this is higher, your customers don't need to hear all this. What they have to do is, how can I get basically enough meaningful benefits for the lowest premium possible? And so let me go into this. Concerns with rising premiums and what to do. We crunch the numbers here. We try to find ways of designing things that can still give you as much benefit as you had before and not really feel the pain of this 20, 30, or 40% increase in some areas. So how can we be creative with designing a plan that's more affordable while still maintaining those benefits? And that's kind of what we did here. I called it Crack the Code. So, today I'm going to talk about the short and fat, which is something you have to understand when we're doing this. A short and fat policy is much better than a long and skinny policy. And I'll kind of explain some of that. We're going to review some of the plan option features received the greatest premium rate increases, the areas that did take on those higher amounts. We remodified the short and fat. We call it short and fat 2.0, and where to get started. So how do we design them? So for years I used this slide right here, and I tried to explain to people. We used to sell a lot of 5-year benefits, unlimited benefits. We sell 5% inflation, like I mentioned. So in this example here, a 5-year plan, which is basically 5 years times the $4,500 a month, $150 a day, That works out to a policy maximum of $270,000. So 5 years, $4,500 a month, 5% compound inflation. Annual premium for that right now, $11,488. This is for a married couple or they're age 60. Naturally, you don't see much 5% inflation riders being sold anymore. Policy maximum to $270,000. That's still okay, but the monthly benefit, the small amount, this $4,500. So for years, I taught people the better way to design this is instead of doing $150 a day or $4,500 a month, ramp that up to $250 a day or $7,500 a month. Put a 3-year benefit period on there. Now, $7,500, well, half of that is $3,750, pretty close to where we were for the assisted living. But then we're going to use 3% compound. And now that my same policy maximum, by the way, we're still going to sell them $270,000 worth of benefit. By shortening and fattening it, we're giving them access to more benefit up front. We're not taking anything away from them. We're just allowing them to access more benefit up front in the short term. It's kind of like taking the lottery. You know, if people are given the option to take what was the payout now, 1.9 billion recently? You know, instead of taking 1.9 billion, they'll tell you, hey, we'll give you 1.4 billion right now. You don't have to wait for 30 years to be paid this. A lot of people take that cash option. Well, just imagine that they want it over a less period of time. Same with your long-term care benefits, except for in this case, they're still going to pay the full amount. So it's very advantageous to take this at a larger amount and a shorter thing. Look what it does to premium. It knocks my premium down, some $3,000 here. So in my opinion, the policy on the right, the short and fat, much stronger. So it's less expensive and it's a much better policy. So now, of course, the argument's going to be, well, what about the inflation growth? It's 5% versus 3. So, well, now it's 4,500, 10 years on the original design. You'll notice there in 30 years, it pays out $19,444 a month. Well, if I look at my one on the right here, and by the way, a 60-year-old couple, average claim happens at 82. So certainly by 90, these people have been on claim. So I've given them more insurance now and more insurance for the next 30 years by doing it this way. And again, I've saved them a lot in premium. So let me take that a step further. So the whole thing I'm doing today is this long, skinny versus short and fat. So like we call this now, and I apologize, I had this slide here, but so I'm calling this now as short and fat 2.0. Okay. So if I'm going to take the same $270,000 pot of money, all 3 examples here, but in this far right one here, I'm going to take that $270,000. I'm going to use $10,000 a month monthly benefit, 1% inflation. Okay, so now it's going to be squeezed down to a 2-year plan instead of a 3 or a 5. But remember, your client's going to get the whole $270,000. That's the idea of having insurance, is having a claim and getting paid all the money that you paid in. So the quicker you give it back to them, the more advantageous it is for them. Because even though at $10,000 a month, maybe they go and claim next year, and the local nursing home is only charging $7,000. Well, the unused amount stay in your account, so it doesn't hurt them to have access to it up front. But look what I did to the premium. Instead of paying $11,488, for my opinion, an inferior policy design, but I'm still giving them $270,000 worth of benefit. Over here, I'm giving $270,000 worth of benefit, stacked a much better way for half the price. So if you can follow this slide here, this is what I'm going to be kind of doing today. I'm going to bring the software up and try to kind of walk you through it as well. Boy, I probably should have had that ready. I had some technical difficulties. I'm going to bring the software up so we do have access to that as I do this. All right. So let's take a closer look here. I'm going to show you 3 areas. These are the areas that the 2020 rate hike, if you will, kind of were affected the most. Females took a little bigger hit than the males. Married couples took a little bigger hit because, of course, we lost the premium, the spousal discount. It went from 30% if they both apply and get coverage to 15%. 3% compound got hit a little bit. And then, of course, the 3-year plans and the 3% compound are the kind of areas that got hit the hardest, if you will. And then, of course, the married discount. So I'm going to show you 3 examples. The first one is just a 60-year-old female. Now, someone buying at that age, the premium was $4,800. Now it's $5,808. We're over here, a 60-year-old couple, their combined premium was $5,965. Now, same benefits going to cost them $8,549. So that's a 43% higher than it was. Over here, same thing. This is a 55-year-old couple that bought a 3-year plan, 4,500 benefit, 162,000. That was 49.69. So I'm going to look at a couple of these areas to show you kind of how to ward those off. So the first one here. Now this is the 4,500 5-year benefit, 100% assisted living, 3% compound. Old rates in 2013 were 48.52. Now it's 58.08. Okay. So first of all, let me kind of show you the software. I'm not going to go through every one of the examples. I'm hoping you guys kind of follow the gist. I have like 9 examples. I don't know that I'm going to need that many. I'm going to take a little slower on these first couple so you can kind of see what I'm up to. But let me bring the software because I think it's going to help see what I'm up to here. If you can't quite see this, I apologize. I'll kind of read them back to you. So what's the plan design here? We got a 4,500 5-year benefit, 3% compound for a 60-year-old female, single. All right, so let's do single female. $4,500 a month, 5-year plan. So that's gonna be 270,000. 3%. $58.08. Is that what it says here? I think it does. $58.08. Okay. So that premium just seems a little high. So what can I do to still offer this, nice long-term care benefit, but get those premiums down a little bit? Because remember, just 2 years ago, that same policy cost $48.52. So I went ahead and started tinkering with this, and I changed this to a $10,000 a month benefit, 50% assisted living, no inflation. I put a $500,000 pot of money on that. Now my premium is actually 6% less than what it previously was. Okay, but look at the benefits. Granted, I don't have any inflation. So in 20 years from now, again, average claim happens at age 80. On the example on your left, 10 years from now, I'm getting paid $6,000 a month. 20 years from now, I'm getting paid $8,000 a month. Where my pot of money again is $363 and $488. Well, over here, my monthly amount is still way above anything we did with this old design. 10,000, 20 years later, it's 10,000. Well, naturally, no inflation growth, easy for 10 years from now, it's a $500,000. So 20 years later, this thing still has a bigger pot of money, and it's still got a lot bigger monthly benefit. Crossover points probably 23, 24, 26 years later. So what I've done here is I've effectively wiped out that higher price, given them the same benefits they had before, just by going shorter and fatter and lower inflation. You don't really take anything away from your client by doing this. I'm hoping you're following this. So let me show you now. Now, if you don't want to go with no inflation, another option here might be to, again, we're competing with this 4,500 5-year benefit, $270,000 pot of money. That's 5808. So on this one, I'm going to take the rates, and I'm going to take this, and I'm going to do a monthly benefit of 8,000. I'm going to do a assisted living facility of 75%. Because remember, 75% of the 4,500 that you originally had would be about 4,000. So certainly, I'm still well above the assisted living. I'm going to put 1% compound in there. I'm going to move my policy maximum to 350. Again, my premium now, it's back to where the old rates were. So I've effectively eliminated this last round of increases, and I've just designed a better policy for them, saved them some money. So my benefit now, 8,000 versus 4,500. I'm killing them. 10 years from now, I'm at 8,800. They're at 6,000. 20 years from now, I'm at 9,700. They're at 8,127. So this is more benefit now, more benefit over the next 20 years, and actually the crossover point is in for 25, 26 years here. And again, I've saved them a bunch of premium. So again, much better to higher dollar amount, lower inflation, shorter and fatter. The third way to do this, another way would be, is I could even use 2% compound if you're someone doesn't like 1%. So let's look at this with 2%. Again, I netted the premium out. This time I took 5,500. I put 75%. I did 2% compound, and I put my policy maximum 290. So again, now the benefits compare 4,500 versus 5,500. In 10 years, 6,000 versus 6,700. In 20 years, same benefit. So I basically netted this out. And again, I charge the same premium as previous rates. So I saved this person 20% off. Now, if you want to argue those longevity in the family, and what if they do live, they don't claim till they're 90? Well, then you can go ahead and put these original amounts at, I don't know, 6,000 instead and 310. So those phosphor points get pushed out a little more. You're still going to be under what you did originally. So you can really do this with a 1%, with a no inflation, 1% or 2% are all going to be better ways of designing it than using that 3%. Because that's one of the areas the carriers, mutual, kind of increase their rates. So we're navigating around where the heart of these increased prices hit, if you follow me here. So I'm going to give you an example here. Let's look at this one here now was the married couple. Okay, married couple age 60. So just to show you what I'm talking about, let's bring the software back over. And first of all, we got a 6-year benefit. So we got 324,000, 4,500 benefit, 100% assisted living, 3-point compound. So let's do married couple at 60. 100% assisted living. So here I'm going to do a 60-year-old couple, 4,500 a month benefit, $324,000 pot limit, which is a 6-year benefit. I'm going to put 3% compound on there. Okay, 100% assisted living, 100% home care. And that premium, of course, $85.49. I hope that matches up. Yep, $85.49. So that's what this policy benefit costs if I want to design it this way. Again, 4,500, just a long, skinnier design. And believe me, I still see a lot of agents quoting this kind of stuff. We want to help you out as much as we can. So if I'm looking at a $324,000 maximum benefit, $4,500 a month, 20 years, again, it's $8,585. I'm going to come over here and I'm going to go ahead and put that thing up to 10,000. Most I can do. I'm going to cut the assisted living in half because remember, 50% of 10,000 is 5,000 a month, still more than what we had here, right? So we're above that. No inflation, so no growth, but big deal. And give it to them all up front. Policy maximum is 500,000. Now the premium, $6,176. You know what? And Lynn, you're probably going to be happy with me. I know we're a little ways through this, and I think I had a pretty good crowd. Yeah, we still do. Folks, I got about another 10, 15 minutes of this. So if you can get through this, the reward is we're doing a drawing at the end of this webinar. We're going to flip a little, it's called a flippity wheel. Everyone that's on this webinar's name is going to be on that wheel. We're going to spin it twice, and we're going to hand out 2 $100 Amazon gift cards to the lucky winners. So I meant to announce that early on. I apologize. I kind of got into it with my intro and didn't mention that. But we are going to give away. It's part of Long-Term Care Awareness Month, the month of November. So we're trying to do a little extra things here for this month. So we do appreciate you guys hopping on board. We are going to give away 2 $100 Amazon gift cards when I get done here. So if I don't bore you to death and you can make it through another 10 minutes here, I'll try to kind of come to the end here. So this example right now, this is the miracle. This is where it really took a big increase. This is where, again, 3% compound took a hit. Married couples, because we lost the extra 15% discount. So you add it all up. If you quoted this, and the old rates, again, they go about all the way back to 2013. So not to beat up on mutual, they did maintain pretty low. They didn't change their rates for 7 years, which is really a long time to hold the same rates. They finally kind of had to. But with these new 2020 rates, or September 2020, about 2 years back, the same plan I was just quoting now suddenly is $85.49. That's going to give some people some sticker shock. So that long skinny design here, 4,500, 324, and now it's 4,500. 20 years, it's 8,100. Now 324, and 20 years, it's 585. So over here, I cut the premium down. I've got just about the same premium where it was before, just 2% higher. So I cut this down to 6,176 annually. By going 10,000, 500,000, no inflation. Look how the benefits shake out. Remember, average claims happen around 80, it's 82.5. So 20 years from now, this benefit pays 10,000. Over here is only 8,100. But now here, the $500,000, this pot's gotten a little bit bigger, 585. But I do know this, 90% of claims don't exceed 2.5, 3 years. So therefore, I'm not really worried about them in a 6-year, not worried about them getting to the back half. There's less than 5% chance, less than 3% chance that they ever get to that 60-year payout. It just doesn't happen. So I'm okay with shortening Fed, even if that means giving them a little less in the long term, because they're likely gonna go off a claim or die before they exhaust that pot of money. Okay, so I'm okay with a little good there. If you're not, you want to match up perfectly. Remember, I've got more here, which I think is more important. I could move this down to 9 and move this to 550, the $500,000 policy maximum. Move the monthly benefit down to maybe 9,000. Still would net out here, and it would net out a little bit better here. Lots of ways to play around. These are just examples of how to do it, but I'm hoping you're getting the gist here. I'm just trying to make a shorter, fatter policy. Okay. So the other one I'm going to show you here is, let's look at it 1% inflation. And there's another reason why I like this 1% model, if you will, versus the no inflation. If I had my druthers, I would prefer to keep 1% on every policy I sell. And the reason for that is Mutual of Omaha has an outstanding benefit. It's called that buy-up, inflation buy-up. If you have any form of inflation in your policy, 1%, it allows you to buy up or increase it to say, 2%, 3%, 4%, whatever you want, anytime over the next 20 years or before your 75th birthday, whatever comes first. But so a lot of times when people are buying a policy in their mid 50s, they may have competing funds. They may have kids in college. They may have, things they can maybe afford to throw more at this later, but they want to lock in the health now. So it allows them to kind of step into more coverage on down the road. So selling 1% compound is more advantageous, in my opinion, than maybe just the no inflation. So when I did this example, again, I'm trying to compete with 85.49 instead of giving my customer a policy that's 85.49 with a $4,500 a month benefit and a policy maximum of 324, about a 6-year benefit. I'm going to shorten and fatten this up. It's going to look like a 4.67 year benefit. I'm going to increase it to 7,500. Okay. Policy maximum here is 420. And so how does this shake out? Well, now I'm at 7,500. They were at 4,500. 10 years from now, 82 versus 6,000. 20 years from now, 9,000 versus 8,000. The pot of money, again, gets a little bit behind, but you can tweak that. Again, I'm not worried about I'm getting to years 5 and 6. It just doesn't happen. But if it did, you could put a little bit more on the policy maximum, change the rates a little bit. What I'm trying to show you here is that basically there's a better way to design a plan that can give them, in my opinion, a lot better benefit. Because if someone at age 60 buys a policy, they retire at 63, they've done pretty well in life. Worst case scenario for this couple is one of them has a stroke at 66. Now they're into their principal, they're into their investments. They were planning on living on that money for the next 25 years, right? They can ill afford a hit early on. Once you get to be 85, 90, the financial hit of a long-term care situation is a lot less. You've already used most of that money already to be cared for. You still want to have long-term care in place, which you do, but the emphasis, the need for it kind of diminishes over time. So I don't mind giving them more upfront and maybe for the trade-off a little less later. Because remember, number one, they may never use it. But if they do need to use it, it's more important in that short term, that right away, that if something happens to that 66-year-old couple versus when they're 87, when that's expected to happen, and you still got your benefits. But so, again, I'm okay with the trade-off. People argue that, well, yeah, but what if they, live to be 90 and if they live to be 95 or 96, average claims there are less than 1 year. Why? Well, because they're 97. They're not going to go on a 12-year claim. Okay. So again, I think the need for it diminishes over time. All right, let's kind of fast track here. I'm going to go to the last example here. This is a married couple at age 55. Now this is where it gets a little tougher because we need to have this policy enforced longer before it goes to claim. It's going to be taking 30 years until they go on claim, right? Average is 82, so 80 at 55. We'd like to look at this 30 years down the road. So first of all, let me bring my software up again here so I can match this rate so you know what I'm up to. So this benefit's a 3-year benefit, $162,000. $162,000 pot of money, 4,500. So I got 4,500. I'm going to put 162 on here. And it looks like the example had 3% inflation. 3% inflation, 3-year, 100%. Okay. $55-year-old couple. There it is. So 55 and 55. Well, a lot of numbers to check on this thing. I gotta tell you, I hadn't done this one for a while. And there are so many numbers to verify before I go live here and make sure they come up. I do want to show you what I'm up to. It's 49. Okay. So the 49.69 you're seeing here, this is again, the current rate. This is for a 55-year-old couple that have 162,000 and 4,500 a month. Okay. So 49.69. Now, just, you know, 2 short years ago, that same policy costed 33.91. And when agents would call here, they're having a stroke. They're saying, well, goodness, so how are we ever going to sell this stuff? Look how much it went up. Well, this is the area that it really maxed out at. This is like the peak of the, if you had a married couple in their 50s that were using 3% compound and wanted to buy a 3-year plan, that was like, you hit all the perfect spots where that was the highest point where you could have gotten it, the rates were higher there. So I wanted to try to attack this one. It wasn't easy, but this is what I came up with. So again, I'm trying to match what this 4,500 and this 162, 30 years from now, it turns into 10,922 and 393. Okay. 20 years from now, which again, 75 could be the claim, 8,000 and 292. Okay. So here, just to match the, first of all, I wanted to say, well, I only wanted to spend 3,300. So I'm not going to probably get everything back they had. But I can come back and still for the premium is pretty close to what it was before, $33.99. I did a $10,000 a month benefit, 50% assisted living, no inflation, $265. So you'll notice here, 30 years from now, this is paying pretty close to what the other style is doing, 10.9 versus 10. Now the pot of money has gotten away from me more, 265 versus 393. So in this situation, I might want to go ahead and bump this 265 to maybe 300,000 or something, so it's more comparable. Remember, I'm going to be well under. What does it even look to if I put that together? Well, let's do that for fun here. Let's see if I can find this 339 first. Then let's see what we can do with that. So this 339 is, let's see, we got 265 and a 10,000 benefit and no inflation. 33, okay, there it is. So this is the redesign, if you will. And so you might argue this 33.99 was the same price that I just put together for you on this other over here. But then I'm worried about that crossover point. The person has longevity in their family. Their mom was in the nursing home for 11 years, and so they're really worried about this thing. And even though it's a long shot, but that's what your customer wants. Well, then I might just say, well, we'll put a little bit more in there. Maybe I'll go ahead and bump this instead of 265. We'll put this at 300. Okay, now it's 36.64. Pretty close to where we were before. What's the crossover point? If you guys don't know how to do this, I'll show you. So what's that pot of money? What's 300,000 going to look like in 30 years? If you don't know how to do this in the software, I love this, but I'm going to preview this. I'm going to look at inflation protection comparison, right? So I'll take a look at this. So at 300,000 in 30 years will have grown to, but this is a lot too. I should almost call this one long-term care advanced, because I know I'm throwing a lot at you here, but I want to encourage you, if you have a plan, you're trying to get the premium down, you're trying to give them meaningful benefits. If you're new to this, don't struggle on this. Give us a call. I'll help you. John Randall will help you. Lynn, our marketing support folks downstairs, we'll all be able to help you kind of put this together. So if it seems like I've gone over your head, or just call us. We'll show you how to do this. So let's see, the 300,000. Where's that go now? I go past it. Okay, the 300,000 in 30 years grows to 403. Where were we at before? So the other one was at 393. So there we go. So by doing that little tweak, putting another $300 in there, I've now matched that out too. So I've matched these benefits. So long story short of this, and I get that I have a couple more examples. I don't want to bore you with these. Here's the thing, folks. You could just have to think about being shorter and fatter, increasing that policy max, increasing your monthly benefit, lower your inflation, sometimes take the assisted living down, and you can get yourself to pretty close to where you were before. Now, forget old rates, new rates. I almost should just redo this webinar telling people, let me show you how to get the absolute most bang for your buck. Agents will sometimes call me, and I encourage you to do this. If it's something you don't do every day, we do. Long-term care might be not something you do every day, but we do, and we do a lot of it. So if you've put together what you think is a pretty good proposal and you want to bounce it off me, I'm happy to shorten and fatten it up and play with the numbers with you. I actually enjoy this. It's weird, but I like helping my agents make that sale. If it means getting things more packaged in a more affordable way, then maybe that agent didn't realize how they could do that. Hey, listen, bring us what you're working on. We'll spend 5 minutes together in the software. We'll teach you how to do it. But so the whole point is we have to be more smarter about how we design plans. We can't just throw, you know what? Let's just do a 5-year benefit, 6-year benefit. Let's do, I don't know, the local cost here is 8,000. Let's do 8,000 a month benefit. Let's put 5% compound on it. Let's, well, you can't quote $13,000 policies anymore. I will argue you won't do very well. You won't last very long as a long-term care salesman if you're quoting things that are 10, 12, 15 grand, unless you're working with extremely affluent people naturally. But for me, most of my customers, price was important to them. Keeping premiums down is crucial. So we're here to help you do that. I hope what I just showed you was helpful. I don't know. I'm hoping it was. At this point, I want to let me see if we have questions here, first of all, before I turn it back over to Lynn and we'll do that little drawing. Well, I didn't bore people. I wonder if it's the Amazon cards or myself. I want to go with the Amazon cards was probably the reason, but where's questions? Let me see if we got any here. Yep, we do. Wow, I got a lot of them. Okay, a couple of people are asking for copies of slides. We email everybody. Okay, I'm gonna answer because please. We will send a copy of the slides to everyone. So then I also want to tell you that there's another question about partnership, and I'm actually kind of glad that came up. Dave, I hope you're doing well. We haven't talked for a long time. Partnership. Now, a lot of the states, and the software will tell us that, by the way. When you go into our software, it's so intuitive that it thinks for you, right? So literally, if I put a benefit on here that maybe isn't partnership certified, so I can actually in some states, what am I in Virginia here? I don't know. Let's just go to, I think it's Missouri. Yeah, let's go Missouri. Missouri will even take some of these, 1, 2, or so that's partnership. You can even drop below in some states. I guess Missouri is not one of them, but there are states that will accept 1%, 2%. Some states won't. But let me tell you that this is my opinion on partnership. Take it for what it's worth. Partnership's a neat benefit. It really is. When it first came out, boy, it sounded great. If I buy a long-term care policy and I have a $200,000 pot of money, and I end up using that benefit and I get spent down and I need care, I can keep $200,000 in my account and I can qualify for Medicaid. Great. That just sounds wonderful. Instead of having to be spent down to $3,000, I'm only going to be spent down to $200,000. That money can go to my family and the state will then take care of me. Well, let's just do an example. Let's just say someone had $500,000 in their accounts. Okay. They bought a long-term care policy for around $200,000. For whatever reason, that $200,000, when you go to claim, maybe that money has grown to $1 million in their investments, but that pot of money has grown to about $300,000 in long-term care, $350,000. Well, so now they can keep $350,000. So that person's going to go ahead and have to go on claim. Not everyone uses the policies, right? But if they do go on claim, they would have to exhaust that $350,000 of the benefits. That might take, again, 3, 4, 5 years. I've already mentioned that less than 5% of people go beyond 3, 4 years. So you talk about over 5 and 6 year claims. Now we're at less than 2% of people. But now this person would have to exhaust that $350,000 in their policy. Then the other money they've got, remember they got $1 million stashed away in their investments. They're allowed to keep $350,000. So they're going to have to spend $650,000 of their own money to get down to that $350,000 to where they qualify for Medicaid. So they're going to have another 11 years of care on top of the 5 years of care. Now we're at 16, 17 years of care. When they get there and they've been in a facility for 16 years or at home, whatever it is, they can now qualify for Medicaid. And I don't know what Medicaid is going to look like 30 years from now, 20 years from now. It's not good now. But let's just say this person's in their home or in an environment where they're getting care. They still got $350,000 in the bank, and they're going to be asked to move to some Medicaid nursing home now. So that because they qualified for it. Well, the states have done partnership for 20 years, and I can tell you that very few people actually exercise it when it gets there. Less than a half of 1% people even get to the point where they can use it. So it's a 1 in 200 shot to use it. And once you get there, most people don't use it. So partnership's a great benefit. It sounds so good, and I love using it to get to a door. When customers ask me about it, you're darn right I'm going to sell them a partnership plan. But I know as an agent, there's a snowball's chance in heck of ever using it. So I never wanted to really design things with partnership in mind. So everything I just did for you guys, the obvious question is, what about partnership? So I'm so glad that you brought that up, because I just don't think partnership is important. So my 2 cents. Okay. And I want to just reiterate what I just said earlier. Listen, if you guys, this is new to you, the shorter, fatter, give us a chance. If you're quoting your next case, give me a call, give Lynn a call, any of our marketers here. We'll help you put together that shorter, fatter plan and try to design more meaningful benefits for your clients so you can help you make more sales. With that, I want to say thank you. I know it's about 45 minutes at the hour, so thanks a lot for attending. We have more special events throughout the month of November coming, so look on our website, goldencareagent.com, for that. And also remember, if you can't attend a webinar, you saw a topic that you wanted to do, we record all of our webinars, and they're available at goldencareagent.com under tools and resources. I believe it's under webinar, pre-recorded, or recorded webinars, so you can find it in there. So again, thanks for coming on board, and good luck selling, everyone.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.